Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Happy Thursday, everybody. One small thing before we begin with the main stories. Yesterday, Wednesday, General Secretary Xi Jinping turned 69 years old, and for his birthday, he phoned Russian leader Vladimir Putin. The Russian and Chinese official readouts on the call were fairly boilerplate, with no suggestion that China is distancing itself from Russia over the Ukraine invasion. It's worth noting that despite Beijing's continued insistence that it is seeking a peaceful resolution, and this birthday call with Putin, Xi Jinping has not spoken with Ukraine's Zelensky since the Russian invasion began. Xi will give a video address at the St. Petersburg International Economic Forum this Friday, and we will be covering any relevant developments that come from that address over the weekend. Okay, first up, the economy, and yesterday the National Bureau of Statistics published official economic data for the month of May. While we need to take official numbers with a grain of salt as always, they normally do give us some idea of general trends. The data showed a recovery in some economic indicators in May, month on month, following a broad contraction in April as lockdowns were gradually lifted, particularly in Shanghai, and disruptions caused by COVID restrictions were eased temporarily, at least to some extent. Industrial production rose 0.7% year-on-year in May after a 2.9% drop the previous month in April, while the year-on-year decline in retail sales, a good proxy for consumption, narrowed to 6.7% from 11.1% in April. Economists at Nomura Holdings Inc. warned in a research note yesterday after the publication of the official numbers, quote, "We believe some fundamentals might be worse than the official data suggest," end quote, pointing to falling production of power, cement, crude, steel, autos, and smartphones, and also an index of road freight, which was almost 19% lower than a year earlier. Another expert expressed yesterday, quote, "We should not be overly optimistic about consumption as the recovery has been quite slow, affected by repeated COVID outbreaks, slower income growth, a cautious view of the future expectations. There will not be a revenge spending as people have expected." Bloomberg economists argue that the gains for the industrial sector were concentrated in the output of coal, which grew more than 10% in May. Unsurprisingly, infrastructure spending is up, being employed by Beijing to replace consumption and private sector investment, which have both been hit hard in recent months. Infrastructure investment has surged 6.7% in the first 5 months of this year, ending May 31st, over the same period last year. The most concerning data, however, for policymakers will be the youth unemployment numbers. China's youth unemployment rate in urban areas in May was the highest since records began in 2018, with the government warning the situation could get worse. The surveyed urban unemployment rate among workers aged 16 through 24, which captures graduates from high school and college, climbed to 18.4% in May from 18.2% in April. We remember that the Ministry of Education has said that 10.76 million university and college students are expected to graduate this year, the most ever, and an increase of 1.67 million over last year. While general economic slowdown and increasing graduate numbers are contributing to the youth unemployment figure, another salient reason is that 3 industries which have historically been large employers of grads, that is, the tutoring, internet and real estate industries, are all facing regulatory crackdowns. If you guys are enjoying the video, don't forget to the like button, and for anyone who wants to go the extra mile, as always, Patreon, Buy Me a Coffee and crypto links are in the description below. This is a massive help for anyone who wants to help keep the channel financially sustainable. As always, thank you so much everybody for the ongoing support. Now let's move to China's 2 most important cities, Beijing and Shanghai. These 2 megacities continue to see sporadic cases, keeping the sword of lockdowns hanging above everybody's head. Shanghai's supermarket bar outbreak is officially a super spreader event, with hundreds of cases across most districts in the capital being discovered. Mass testing remains in place too, not just for these two megacities, but across the country. Yesterday, Wednesday, Shanghai's Health Commission announced that all Shanghai districts will arrange massive community PCR screenings every weekend through the end of July at the earliest. During the sample collection in at-risk districts, temporary lockdown measures will be kept in place, which are lifted immediately after the sample collection is completed. Meanwhile, this week, the American Chamber of Commerce in China, AmCham, published its June COVID impact survey for US businesses. The survey found that 93% of respondents have cut their revenue projections for the year. 25% of customer and service companies have decreased their investment plans, as have 20% of manufacturing companies. Only one respondent plans to increase their investment in China. 26% of manufacturers are accelerating the localization of their China supply chains while moving production of global products out of the country. While the majority of US businesses in Shanghai have resumed operations following the city's devastating lockdown, their levels of operations are still well below normal due to the continued restrictions on movement. Only 31% of manufacturing and services companies surveyed by the American Chamber of Commerce last week said that they were fully operational. 2/3 of the American Chamber's member firms are now operating at above 75% capacity. Local players are experiencing issues too. According to analysis by China International Capital Corp, about 55% of Chinese-listed companies, which announced the suspension of operations in Shanghai, said that they had resumed them by late last week. And according to logistics company G7 Connect, truck flows in Shanghai in the week through Sunday of last week are still at just 53% of the average level seen in 2019. And last up, the Chinese property market. Chinese developers are about to enter one of the most challenging periods that they have faced so far, as many crisis-hit firms face immediate deadlines to repay multi-billion-dollar debts. We have already seen in recent months many big players scrambling to get extensions on outstanding loans and debts. According to data from the China Real Estate Information Corp, 200 major Chinese developers will see debts totaling 175.5 billion yuan, $26 billion maturing in June and July, about 61% of the total maturities in the second half of this year. 2/3 of the outstanding debt is from private developers, and nearly half of the debts due by the end of July are for offshore bonds. But with the housing market in the toilet, tight financing, and as we saw yesterday, restrictions on reducing asking prices, developers simply do not have the money. Firms like Jinke Property Group, Datang Group Holdings Limited, and Shanghai Shimao Group have sought to extend debt payments over the past few months. And we remember that Sunac China Holdings Limited, China's fourth largest developer by sales, recently won support from its bondholders to extend repayments of a 2.3 billion RMB onshore bond for 2 years. In the previous wave of debt maturity for developers back in March and April, a total of 22 onshore bonds were extended, normally seeing just 1 year delays for extensions, however. Though domestic bondholders are likely not happy about seeing more debt extensions, they may have no choice. Indeed, one bondholder speaking to domestic financial media outlet Yicai expressed yesterday, quote, "Under the authorities' call for financial stability, domestic bondholders can only accept the extension no matter what terms developers offered." End quote. While this does buy time, it doesn't help repair shattered investor confidence, nor does it deal with the moral hazard that drove the industry into this crisis in the first place. And this debt remains in the economy, and sooner or later, it will have to be repaid. Okay, that is today's episode. Thank you so much, everyone, for listening. I'll see you tomorrow.